Yeah, really excited. Of course, 2023 of all about being efficient, your cash runway, all that great stuff, right? That's the theme of 2023. So, of course, as a CFO, I say financial discipline never goes out of style. So happy to present on go-to-market metrics today.
The floor is yours. The floor is
All
yours.
right. All right. Thanks, guys. All right. Well, greetings, everyone. Again, my name is Ben Murray. Happy to present today. Thanks for the invite. Really appreciate it. So let's dive right into it. I've got a lot of material to cover today, and hopefully I can share the slides somehow after. Happy to share these slides as well. So today, the SaaS CFO's Guide to Achieving Go-to-Market Metrics and Financial Transparency. So a little bit about myself, if we have not met yet. My name is Ben Murray. I'm a SaaS CFO by trade, and I focus on the 4 C's right now: courses, content, coaching, consulting. I've been in finance and accounting my entire career, 9+ years as a SaaS CFO in-house and now fractionally. Worked in the airline industry and then got into software and started blogging about all things SaaS metrics about 7 years ago at the SaaSCFO.com. So really appreciate being here today. So today's agenda, we're going to talk about my 5-pillar SaaS metrics framework, and then focus on pillar 5, the go-to-market efficiency metrics. Talk about go-to-market data, right? Data is so important. We need that to calculate the metrics, and then hopefully have some time here for Q&A, and I'll watch the time here. So this is my SaaS metrics framework. Feel free to take a screenshot, use this in your company. I use this for my fractional clients. I teach this in my course. We're going to focus on pillar 5 here, so efficiency. And with SaaS companies, of course, when we think efficiency, we think about sales and marketing efficiency metrics. There's also org efficiency, revenue per FTE. How many wages do we invest to get our recurring revenue? That's a whole nother topic. But again, today, talking about pillar 5 and our go-to-market efficiency metrics. So why is this important? And I think we know, but what's my return on sales and marketing spend? As a SaaS CFO, we're investing a lot as we scale, as we move from founder-led sales and build out our first go-to-market engine. It's really important to understand the ROI of that spend, because we want to avoid that big black hole of spend. And early on, this happens. When I've become a CFO at some companies, we just didn't have the data, the process in place, and department leaders came to me for requests and didn't have any justification. Okay, that's fine. I'll let that go. But next time we've got to justify this. So we want to avoid that black hole of spend, whether it's sales and marketing, whether it's dev, whatever department in our SaaS company. We need to understand as we invest, what's the expectation of that investment? And can you answer this? So RevOps leaders, my go-to-market leaders in the audience, SaaS CFOs, can you answer this question? For every dollar of investment in sales and marketing, how much ARR does it produce? So can you answer this question? If you can, great. Let's keep talking. If you can't, I've got some great information for you. So where do we start? There's so many metrics in SaaS companies. Just where do we start for go-to-market efficiency metrics? So when we look at what I call our CAC profile, our customer acquisition cost profile, or our go-to-market profile metric, there are 5 common metrics that SaaS companies use, SaaS CFOs especially use, to determine the efficiency of our spend in sales and marketing. So of course, first is CAC. And if we look at this circle here, we've got CAC, which could be our gross sales and marketing dollars, also our CAC on a unit cost basis, so how much to acquire a customer. We've got our CAC payback period, which is one of my favorite metrics. Then at the bottom of the circle, we've got the cost of ARR. And then we've got LTV to CAC, and then the SaaS magic numbers. So 5 popular and important metrics to understand the spend in sales and marketing, and then understand the efficiency of that spend. So a little bit about these go-to-market metrics, and these may be very familiar, but I'll cover these in detail or just briefly on this slide. And I've got an appendix. If we're able to share the slides, I've got an appendix with all these calculations and formulas. But first, CAC, of course, the cost to acquire one new customer. So we're looking at our sales and marketing spend and the spend that's just related to acquiring new customers and users. We don't use all our sales and marketing spend unless we're early stage and just acquire new customers. We don't have any expansion potential yet, but that cost to acquire one new customer. Next, all right, we acquire that customer. How much does it take to pay back that upfront CAC cost? That CAC gets tied up. That's working capital that gets tied up in the payback period. Next is the cost of ARR, or aka the SaaS CAC ratio. So the dollar cost, or whatever your currency is, the euro cost, the pound cost to acquire a dollar of net new ARR, one of my favorite metrics, some great benchmarks, and I've actually have a benchmark on this later in the presentation. And then LTV to CAC, of course, the ubiquitous SaaS metric, that balance between customer value and CAC. And I'm a big proponent if you have a small price point business, so low ACV, high volume, LTV, CAC, very important. Gets a little squishy, a little ambiguous if you're targeting mid-market enterprise customers, because we can know those ACV ranges can be all over the place. And then finally, SaaS magic number. And that's our quarter over quarterly revenue growth and annualized divided by our previous quarter sales and marketing spend. And again, I think that's best suited for high volume, low ACV, shorter sales cycles. We'll talk about some nuances here, but those are the 5 most common go-to-market efficiency metrics that we need to use as SaaS CFOs and as sales and marketing leaders to understand the investments that we're making in our sales and marketing team and our go-to-market team, and what's the payback in the end. Because we know as we scale SaaS companies, there is a lot of investment in sales and marketing dollars, and we have to understand what's happening with those dollars. But context is important here. Of course, as a SaaS CFO, I'm looking at that circle, so CAC, cost of ARR, and so on, but we have to have context within our business. And that's where things can get very dangerous within SaaS companies when we focus on just one metric without context. So of course, I'm looking at pillar 5, but I'm also looking at pillars 1 through 4 to determine the overall financial profile of our business, what's working, what's not working. And there are metrics that relate to each other. For example, CAC payback period relates to retention. So say we're targeting mid-market enterprise customers and our CAC payback period is longer than we want. Let's just say it's 24 months, just above those benchmarks. That's pretty long. But what if we have a high gross revenue retention number? What if our gross revenue retention is 95% on an annual basis? That's pretty darn good. That's best in class. So then I have a little bit more comfort that our payback period is longer. Now flip that. What if we have horrible retention? We don't have product market fit. We've got 24-month payback, but we have poor retention. Let's say 80% retention for enterprise customers, and that's not that great. All right, we've got a problem. So context is so important with SaaS metrics. So the go-to-market metrics process, and I flipped the GMT. I was thinking maybe time zones here, but the go-to-market metrics process. So first we're starting with the data. Then we've got to calculate. We've got to define those formulas. Then we need context. Then we need to benchmark those metrics. How are we doing? And then we iterate. This is a never-ending process. You don't just calculate your go-to-market efficiency metrics 1 month and forget about it for 6 months. I'm constantly calculating these numbers every month when we close the books and then forecast our business. And then if you do have any questions, please throw those in the comments section. Happy to answer any questions as we go along here. So the data with go-to-market efficiency metrics. So when we think CAC metrics, our go-to-market efficiency metrics, what do we need for this transparency? So first we need sales expense, of course. Then we need our marketing expenses. Very important. So 2 distinct cost centers within our SaaS company. Then we need all important booking state. I'll talk more about this. We need our layers of new MRR and ARR. We need logo counts. So a logo could be a user, a customer, an entity. And then we need our gross margin, because a lot of go-to-market efficiency metrics are gross margin adjusted. So we need 5, 6 different data sources in order to understand go-to-market efficiency. So where is this coming from? So it's a lot of different data sources. Hence, that's why this can be very difficult to calculate if we don't have the data in place. So our sales and marketing expense is coming off our SaaS P&L. And if we have the proper SaaS P&L setup, very easy to isolate sales and marketing expenses. I see hundreds of SaaS P&Ls with my clients and coaching clients, and I'd say 90% are incorrect. So the SaaS P&L structure, so important to manage our SaaS business. Next, our CRM system. So bookings data, so important. It is difficult to calculate go-to-market efficiency without great bookings data. So if you have a closed won process, targeting mid-market enterprise customers, you know what I'm talking about. If you're self-service and don't speak the bookings language, we'll get it another way. We need it through our layers of MRR, maybe through the Stripe payments or invoicing system. We can still get new customer counts, new MRR, expansion MRR. And of course, we need logo counts coming from our CRM or invoicing system. And then we need our gross margin coming off our SaaS P&L. So again, the data that we need and the systems that those are going to come from. I won't go into detail here, a little bit more detail. Hopefully I can share the slides later, but a little more detail on the data that we need in order to calculate our go-to-market efficiency metrics. So the biggest data mistake that I see when I'm helping SaaS companies understand their investment in sales and marketing is bookings data. So not tracking bookings data for one, or poor tracking of bookings data. So you know what I'm talking about at the RevOps conference? We have to have clean bookings data. Without this, we cannot calculate our go-to-market efficiency metrics. Plain and simple, it's a hard stop right there. So this is a day one thing where we need to track our bookings, whether that's a spreadsheet, whether that's in HubSpot, Salesforce, whatever your CRM system is, we have to have good, clean tracking of this data. And not only just bookings data, but we need it by revenue stream. Don't mix subscriptions with services bookings, for example, or variable revenue. I need to know every distinct revenue stream that we're contracting for in our CRM system, and also the length of those. I've seen some companies, they book a 3-year deal and they put 50,000 in there, and then they book a 2-year deal, put 30,000, and they don't distinguish what is the ARR that they just booked. So that's great, but it doesn't really give me the information. So the CRM setup, that opportunity setup, is so critical to have that transparency, that then that's going to feed my go-to-market efficiency metrics. So if you're going to do one thing right, it's that proper opportunity setup in your CRM system. And also, we know in due diligence, if you're going to fundraise, if you're going to exit, they're going to ask for your bookings history. So make sure that's set up. It's going to save you a lot of pain down the road. So bookings, I have a template on this, and hopefully you can see the screenshot here. But what I'm looking for as a CFO, and this is how I summarize my bookings data, that was like a day 3 report for me. As soon as the month closed, I was working with my sales operations team. All right, is our CRM system set? Have we closed out everything that we're going to close out, close won, close lost, whatever it is? Then I would pull my bookings data and create my report, make sure I tied out with my sales ops manager. Really important, just like our financials, we need extreme data integrity in our CRM system. It can't be changing. We can't reopen those opportunities 6 months down the road without some control, some processes in place. So when I'm looking at bookings data, we're looking at new customer ARR. What do we get from new customers? And then also maybe we have services, some onboarding setup configuration. We need to book those services revenues. Then from our existing customer base, did we upsell, cross-sell? What's our expansion on a net basis? One area that you need to focus on is, of course, it's great to know that gross revenue from expansion, but for our go-to-market efficiency metrics, we need the net incremental expansion. So for example, if they're paying us 12 and we sold them product line B and now they're paying 20, that 8K difference is what should be booked and show up in our closed won opportunity report. And then that feeds our sales and marketing efficiency metrics. Of course, we get services, other revenue streams. So a simple way to summarize your bookings trends. And also, again, this is what I use to feed my go-to-market efficiency metrics calculations. So calculation. So we've got the data, we've got the setup. So now we've got to calculate. So we have to define those formulas. I have an appendix in this slide deck that hopefully I can share where I've got all these formulas and calculations. So we have to define the formulas, the parameters, and the nuances. And that's the big thing with SaaS metrics. Am I measuring my sales and marketing efficiency metrics on a 3-month trailing basis, a 6-month trailing basis, a 12-month, or a 1-month? How are we segmenting those metrics? So again, that's really important. And then we can calculate, then we need to calculate historical and forecasted metrics. So that's a big thing. We're going to calculate historically, and then also I'm going to forecast those metrics. And who's calculating your sales and marketing efficiency metrics? Most likely, if you have a CFO, your CFO should be doing this. Or if you have, or he or she has an FP&A team, that goes to the FP&A team to calculate. Or if you have a fractional CFO like me calculating this, so hopefully someone on your team is calculating these metrics for you. So now the process with go-to-market efficiency. So what am I looking for as a SaaS CFO? Well, we're looking for context, trends, and then we're going to benchmark our business. So how are we doing against our peers and the top performers in the market? So context, so important with SaaS metrics or board presentations, for example. We need more than one point in time. We have to understand where we've been trending, where do we stand today, and what's the forecast for these metrics. So here's a CAC payback period chart. And actually, this is a real life SaaS client example. You can see not a great payback period. Going way up, they had a lot of issues here. Things got out of control, cut back. You can see CAC starting to come down and then forecasting it lower. So the context is so important when we talk SaaS metrics. So where are we today? Where have we been and where are we going? So trends, do we see a pattern? Are we on an upward, flat, or downward trajectory? And then what actions do we take? Based on that forecast, say for CAC payback, is that what we expect, or do we have to make some adjustments? And that's where we can be proactive with our SaaS business. If we see, for example, CAC payback going in the wrong direction, why is that? Is that expected? Is it okay? But we don't know unless we calculate and forecast. So again, CAC payback, you see we're on a bad upward trend, the red, then we kind of stabilized even though it was very high, and then it starts going down. Right? So there's a history with each of these SaaS metrics. And then benchmarks. How do we compare against our peers and top performers or our internal targets? So one is calculating for ourselves, and then we should benchmark. So these are the guideposts to understand how we're doing against the market. So this is a SaaS metrics dashboard app that I created that I use for my clients, but benchmarking, this is a point in time benchmark. And you see the color coding, red, yellow, green, and then gray, meaning we just don't have enough data for that metric. But on the right side, you can see my efficiency metrics. So a lot of green on the board. We're doing good against our benchmarks. So we have to understand, of course, our internal performance, and then I like to benchmark against our peers just to see how we're doing in the market. And also that's great for due diligence discussions. If you've got a lot of green on the board and pushing for that higher ARR valuation, benchmarking your metrics really helps in those discussions. And then context again. Here's CAC payback period against that horizontal benchmark line. So how's it trending? How are we doing against our benchmark? How are we doing against our best-in-class peers for these metrics, and what work do we still have to do to get there? Because again, these metrics help support your valuation discussions if you're looking to fundraise or if you're looking to exit. So again, metrics together. Metrics in isolation don't mean much. So remember that we can't just, for example, focus on our CAC payback period. We've got to look at LTV to CAC. We've got to look at the magic number. We've got to look at the cost of ARR. So we've got to look at context. So this is an example of a financial, the metrics dashboard. You see a lot of red on the board. We don't even need to focus on pillar 5 here because things are not going well with this business. So we see the context of what's happening. Now, what about this business? There's no growth, no investment in sales and marketing. You see, we're only spending 11% of our revenue in sales and marketing, and that's very evident. Look at the red on the board for new bookings and expansion bookings. Our velocity is decreasing year over year because we don't have much investment in sales and marketing, and you can see that in the form of new and expansion growth. And then from an efficiency perspective, actually some green on the board. Now, do we give the SaaS company a lot of credit for that? Well, maybe not, because they're really not investing much in sales and marketing. So, once they start investing, this profile may change. Maybe it gets a little heavier. Maybe it's not as efficient. So metrics together are much more powerful. And then what about this SaaS company? 22% investment in sales and marketing. And their GTM profile, not too bad. It's okay. New bookings growth have slowed. So should we invest? Do we have the right foundation in our go-to-market engine to continue to invest? And what's the expected payoff? So once we have this set, then we can understand, do we have issues? And again, we like to put a ton, especially CFOs, a ton of pressure on sales and marketing. But it could be more than that. Do we have a broken business model? It could just be more than GTM and more to CAC. Do we have margin issues? Do we have OpEx issues? Are we over-investing in other areas? And again, CFOs work a lot with sales and marketing. We like to put a lot of pressure on sales and marketing, but it could be more than just a go-to-market issue. But of course, we could have a poor CAC profile. Should we pause further investment? Do we pull back, invest? So that's what we need to figure out with our go-to-market efficiency metrics, because we want to avoid burning cash, especially in 2023's environment that funding is not as accessible. That's more expensive. We've got to be careful with our cash runway. So next steps with go-to-market efficiency. Do we pause, cut, invest more? We've got to constantly iterate on this financial cycle each month. So helpful tips with go-to-market efficiency. This is a big one with sales and marketing efficiency metrics, the sales cycle alignment. Do you have an average 3-month sales cycle, 6, 12, 24? That's going to determine how I calculate my go-to-market efficiency metrics for your business. So for example, if you're a self-service SaaS business, low price point, high volume, they come to your site, sign up, free trial, whatever it is, I'm going to calculate your go-to-market efficiency maybe on a 1 and trailing 3-month basis. But if you have higher ACV products, say you sell a 100K ARR product, $1 million ARR product, your sales cycle could be 12 months, 18, 24 months. I'm going to measure it over a longer period. So really important in your measurement of go-to-market efficiency. Then finally, segment. So we have to segment our CAC and go-to-market efficiency. So first we calculate in aggregate, and then we need a segment. It could be based on SMB versus enterprise. It could be regional. It could be country differences. So depending on your size, maybe if you're above 10 million ARR, most likely you're going to need to segment your CAC metrics. If you're early stage, probably not yet. Let's just calculate those metrics. And PLG motion, boy, this has really messed with SaaS metrics. So we make that sale, and then what about that expansion? Who gets credit for expansion post-sale? Do you have natural organic expansion that may shorten your payback that we've got to consider in our CAC calculations? Or does your sales team get involved and help with that expansion? So that's making some of these metrics a little bit muddy, because think, we have the pre-sales, we acquire that customer, then we have post-sale expansion. So you can answer that. Who gets credit for that post-sale expansion? Is it because of how we've set up our product that they can naturally expand in our product? Or does sales and marketing get involved with that expansion, and that affects our SaaS metrics and the efficiency of our go-to-market engine? So real quick on the systems, of course, with CAC data, CRM setup, invoicing, general ledger, and our SaaS P&L in order to calculate SaaS metrics. Not just bookings data, we've got to pull together a lot of different data sources for this. So benchmarks. Again, tons of benchmarks. I can't cover all the benchmarks today, but I partner with Ray Reich, founder of RevOpsSquare.com, and the blended CAC ratio, or the cost of ARR, one of my favorite metrics. So how much does it cost to acquire a dollar of net new ARR? And in this case, we're seeing median performance for SaaS companies, $1.33. Top performers, basically $1 for dollar. And then with these metrics, I like to benchmark SaaS companies based on their ACV size. Really important. Our profile is going to be much different if we're targeting $1 million ARR contracts versus a $10 price point each month. So you can see for those customers, or for those SaaS companies with a greater than 100K ACV, top performers took them $1.42 to acquire $1 of net new ARR. On the lower side, lower price point is down as low as 70 cents. So a great way to benchmark your business, and also to call BS on a forecast as well when you look at the bookings forecast compared to sales and marketing. So if you'd like to benchmark your business, I'll throw this URL real quick, just SaaSKPIbenchmark.com. It's free. Go there if you'd like to benchmark your business. So with that, that's it for today. I covered a lot of material. I'll open up to Q&A, any questions or comments, but really appreciate coming on today, but happy to answer any questions.